Every single month, long before you can touch a single dollar of your salary, a line of institutions takes their cut. The federal government, the state, Social Security, and Medicare carve out large portions of your paycheck automatically. You have no say, no negotiation, and no opt-out. This arrangement highlights a core inequity. The tax system treats different types of income very differently. People who earn a salary through a W-2 are placed at the absolute bottom of the efficiency ladder, paying a higher effective rate than business owners and investors. Compare a W-2 employee and an investor who both gross $80,000. Their starting lines look identical, but the finish lines differ. Because of taxes, Social Security, and Medicare, the employee's $80,000 is slashed to roughly $55,000. The investor pays zero in those, keeping $68,000. The investor legally pockets an extra $13,000 a year because the employee is playing by the default rules. To stop overpaying, you have to adopt the strategy used by the wealthy. Legally shrink your taxable target before the IRS ever runs their calculation. Before you can shrink that taxable target, you first have to clearly understand exactly how the IRS actually aims at it. The United States uses a progressive tax system where different portions of your income are hit with different percentages, rather than one flat rate. Think of your salary as being divided into different portions. The first $11,000 you earn fills the 10% tier. Once that is full, the next portion goes into the 12% tier, and then the 22% tier. You only pay the higher rates on the money that falls into those specific higher tiers. Misunderstanding this logic fuels the marginal tax rate trap. This is the common misconception that a raise can push you into a higher bracket and somehow result in a smaller take-home paycheck. If you earn $95,000 and receive a $10,000 raise, that extra $10,000 crosses into the 24% bracket bucket. The IRS slices 24% off the top, but the rest remains untouched, leaving you with $7,600 in new wealth. A higher tax bracket only ever applies to the extra dollars you earn. Under this math, more gross income always guarantees more net wealth. You can use this bracket math to your advantage. Since the IRS only calculates tax on your taxable income, pre-tax contributions serve as a legal shield that shrinks your target before the formula is applied. This is the primary function of a traditional 401k. If you earn $70,000 and contribute $10,000, the IRS only sees a $60,000 target. At a 22% tax rate, hiding that $10,000 instantly generates $2,200 in tax savings. Beyond the 401k, the Health Savings Account, or HSA, is the most powerful tax shelter available to employees, yet it remains widely ignored. The HSA offers a triple tax advantage. Your contributions are tax-deductible, investments grow tax-free, and withdrawals for medical costs are tax-free. These accounts function as legally engineered levers. They are built into the tax code specifically to allow salaried workers to alter the IRS math in their favor. Shrinking your taxable target doesn't just save money today, it acts as a wealth accelerator. To see the long-term stakes, we tracked 2 employees over 30 years, both starting with a $70,000 salary and a $500 monthly investment. Investor A uses a standard post-tax brokerage account. They pay taxes up front and on growth. At an 8% return, their portfolio terminates at $578,000. Investor B uses the tax shield strategy, reinvesting the $2,200 saved. Adding that shielded capital every year at an 8% return, they finish with $780,000. That's an extra $202,000 created by mathematical efficiency. While these accounts help, the ultimate tax strategy involves business income. Self-employed individuals can access deductions for home offices, travel, and equipment, expenses that lower their taxable target in ways a W-2 worker cannot. The tax code explicitly rewards business activity. Launching even a small, legitimate side hustle changes your structural relationship with the IRS, providing access to a level of efficiency that salary alone can never match. You can start fixing your strategy today. First, log into your benefits portal to ensure you are capturing your full employer 401k match. If you aren't, you are leaving free money on the table every month. Second, check if your health plan is HSA eligible. If it is, open and fund that account immediately to begin utilizing the triple tax shield. Third, stop letting the fear of tax brackets limit your income. Negotiate for every dollar and consider registering a legitimate side business to gain access to 1099 deductions. The default system is rigged against the salaried worker. But by pulling these specific mathematical levers, you take control of your wealth and stop overpaying for your own hard work.